All right. Sorry I was late. It's just been one of those days. With advising, and by the way, I don't know if I think maybe there might be one or two people in here who still needs to come see me. You one of them? Okay. So if you need to just get something set up with me, email me, and we'll get a time set up where we can get that taken care of. All right. Tonight, what we're going to do is we are going to finish the material for your test, which is next week, test number 2. We're going to take a look at your study guide. There are some practice questions, and if any of you have any questions about that in terms of how to work the questions, I've got the solutions here. So if you go to the Canvas homepage and you work your way down. Now tonight we're covering chapter 10, but if you work your way down here, you'll see the Test 2 study guide. You'll see Test 2 practice questions, and then you'll see the practice questions work with the solutions. So I've gone through by hand and just with calculator inputs, and this is really, really good practice for test number 2. Test number 3 will be the last Tuesday of classes, so I think it'll be 3 weeks from tonight. And it's going to cover 3 chapters, so it'll cover chapters 10, 15, it's not 16 and 17, it's one of these two. So, and again, we'll take a look. It will cover, now this is the 3rd test, okay? So it's going to cover chapter, oh no, wait a minute, it's changed completely. Okay, let's see. Okay, so 15, 16, and 18. Okay, so that's right. Let me go back here. Now, I will tell you that the 3rd test covers a very, very small amount of material. Okay, 15, okay, there we go. Compared to the first 2 tests. And so if we take a look at the study guide, I'll just go ahead and pull that up and we can take a look at it. We'll go back and take a look at it in a few minutes. But you can see it's going to cover chapter 7 from your textbook, and then I'll make this larger in a minute. Then it's going to cover the money markets handout, which, by the way, does anyone need a copy of this handout if you haven't been here? Okay. One more? Yeah. Anybody else? Any others? Okay, so it'll be, and the handout that I gave you in chapter 9 in your book, they kind of run together, talking about mortgage markets. So that's what this is, and then chapter 10, which we're going to talk about tonight, which basically talks about the bank's investment function. So that'll be test 2, and then we'll have test 3. Now, remember, you also have your paper due, what's the official due date for that? When? The 25th. What's the Tuesday? What's the last Tuesday of that's the Tuesday before the last Tuesday of classes, right? I'm trying to think. If you need, let's say the 25th, if you need a few extra days on your paper, I could push it back until, trying to think, Sunday. I could probably push it back until that Sunday night, which would be whatever the Sunday is after the 25th. The 30th? Okay, I could probably push it back to then. Now, this is kind of the way it works, and this is why I need just a little bit of time, is the last week of classes, you'll take your third test. I will need to have your papers graded about halfway through the week so that I can calculate your final average. So if the last week of classes, you've taken your 3 tests, you've turned in your paper, you've got your final average, and you're happy with your grade, you're finished with this class, okay? You don't have to worry about the final exam. But if you do want to take the final exam, then I want to get you your final grade back early enough so that you can prepare to take the comprehensive final if you want to try to improve a test score. So that's why Sunday's about the latest I can push it back and still get all the 40 papers graded, test graded, grades calculated by the middle of the week so that you'll know whether you want to take the final or not, okay? So let's just go ahead and push it back until the 30th. That if you need that time. Now, any of you who want to get your paper turned in early, I'm not going to complain at all, okay? That'll give me a head start on getting something graded. I don't know if any of you have ever read 40 papers or not at 2 or 3 sittings, but it's not the most fun thing in the world to do, okay? It's not that I don't appreciate your great writing skills and your great papers, but you just start reading those papers and they just kind of start running together. So the 30th, that'll give you a little bit of extra time. What else? Anything else that we need to discuss? I don't know if we talked about this last week or not. I posted several jobs, and I'm going to, I think I've got 1 or 2 others to post. Banking-related jobs, some are full-time, some are part-time. So if you are interested in any of those, some of them, I'm supposed to collect the resumes for the employer. Others, you can just send them directly. So if you have any, just let me know. All right, so let's go ahead. If you have any questions, you can stop me along the way. Let's go ahead and jump into Chapter 10, which is the bank investment function. And we'll take a look at this. We'll get this knocked out, and then we'll see what we're going to do from here. When yesterday, I had big plans of covering Chapter 10 and Chapter 15 tonight in class. That was before I woke up this morning with whatever's blooming today affecting my allergies and hardly able to talk. So that might change some. So what it may change to is, like for Chapter 15 is not very technical. Actually, Chapter 15, 16, and 18, they're not very technical. I don't even know if there's a calculation in the entire 3 chapters. So what I may do is I may just record one of those chapters on integrity, and then 2 weeks from tonight cover the final 2. Just kind of depends on, but I don't think that'll be an issue. But let me remind you that Chapter 7, I think that's the chapter, is recorded as integrity video, okay? So when you're preparing for the test, studying for the test, that type of thing, I did record one of those that we did not talk about in class. All right, so the investment function of a bank. Now, we talked about this very early in the semester, and we said basically the way a bank works is when you make a deposit, so when you put money in your checking account, your savings account, a certificate of deposit, whatever, the bank can essentially, well, after 3. The first thing is it has to keep a small portion of that money on reserve. Okay, we call those required reserves, and we talked about that way back in Chapter 1. The other 2 things, it can either loan the money out or it can invest the money. I mean, that's it. That's all they can do with it. We're going to talk about loans in Chapter 16 and Chapter 18. So we'll look at different types of loans. We've already talked about mortgage loans. But tonight I want to spend just a few minutes talking about the investment function of a bank. Because, I mean, that's a big part of it. Because if a bank doesn't loan your money out, of course it can earn higher rates of interest on loans. But there are some reasons why banks don't want to loan out all of their money. And there you have to invest it, so they have to choose wisely in terms of which investments they're going to use. Okay, so the functions of a bank's security or investment portfolio. 1, it stabilizes the bank's income. Of course, you know interest rates go up and down. Our economy goes through ups and downs. Sometimes a bank may have heavy loan demand. Sometimes it may have a relatively light loan demand. And so these investments, typically government bonds, they help to stabilize or smooth out the bank's income stream. Offset credit risk. Of course, banks are limited, and we'll talk about this a little bit later, but banks are limited to the types of investments they can make. For example, a bank can't take your deposit money and invest in the stock market. It's simply too risky. So normally they have to invest in investment grade bonds, whether it's government bonds, government agency bonds, municipal bonds issued by the state of Kentucky or the city of Murray or whatever. They have to be investment grade securities. Also, providing geographic diversification. That helps because, again, if you have a loan portfolio situated in a small geographic area, then investing in other areas or other types of bonds issued by either different states, different municipalities, that's going to help offset your risk. Providing a source of liquidity. If a bank has to, now they don't want to a lot of times, but if they have to, if they have government securities, they can sell those pretty quickly. And as you learned in Finance 330, a liquid asset is an asset that can be converted into cash quickly without a significant loss in value. Okay, and that second part is very important because you can sell government bonds. There's a huge market for government bonds. You can log onto your account and sell them within seconds for whatever the current market price is. So you won't lose money or much money on those. Reduce your tax exposure. So if a bank has invested in municipal securities issued by states, state governments, county governments, local governments, typically they don't have to pay tax on the interest income from those bonds. And that's a huge benefit for banks. Collateral, we'll talk a little bit more about this later, serve as collateral, hedge against interest rate risk, provide flexibility, and dress up a bank's balance sheet. So again, some banks utilize all of this. Most banks only use probably 3 or 4 of this list. But again, investment's really, really important function of a bank. Now, this says this is an investment policy. All banks have to have a written investment policy. Basically, what it says is what you have listed here. Okay, so they have to include this. For example, they have to include in their investment policy the quality or degree of default risk exposure the institution is willing to accept. So essentially what that's saying is, how much risk do we want to take with our investments? Some banks are willing to take a little more risk than others. We talked last week about mortgage-backed securities and how they were a disaster for a lot of banks back in 2006, 2007, 2008. So again, even though the bank's investments aren't supposed to carry a lot of risk, sometimes they carry more risk than the bank actually expects, depending on what's happening in the economy. The second thing, the maturity range and the degree of marketability for their investments. So again, there are different types of investment approaches, which you'll see at the end of chapter 10 that I'm going to have you read on your own. But there's a lot of different investment approaches. So depending on the management of the bank, depending on their risk tolerance, and depending on what they're trying to match up, because this could also get into the asset liability category that we've talked about earlier. This is going to be an important part. The goals sought for the investment portfolio. Some banks, for example, if you've got a family-owned bank and they don't want to take much risk, and this bank serves basically to serve the family members and a few community members, I've seen banks who would have 80 to 90% of their deposits invested in bonds. They make almost no loans at all. The reason is the family members who own the bank are wealthy enough they don't have to borrow money, and the community members who want to borrow money, the lending standards are so high that almost nobody qualifies for a loan from the bank. Now, that's not an accident. What they're doing is they're using that bank essentially as their own personal savings account. And they invest heavily in securities. They don't want any risk. They don't want to lose any of their deposit money. So again, it depends on the bank. Other banks try to loan out as much money as possible. They have a little bit of money left over that they will invest, but investments are a very, very small part of their overall goal. So it really depends on the bank and its goals. Also, the degree of portfolio diversification the institution wishes to achieve with this portfolio. And again, this is up to management. Some management teams like to take a lot of risk. Others are very risk averse. And when it comes to investing in government bonds, I mean, you all know that's not the most exciting investment you can choose. But that's for a reason. And again, it's to protect the deposits of the American public. That's why they limit what a bank can do. So within the investment policy, and when regulators come in, they take a close look at a bank's investment policy. They'll look through it. They'll make sure that it covers every possibility that could happen. And if it doesn't, they'll make them change it, update it, whatever. And of course, policies have to be updated quite often because as we go through time, the level of sophistication of investments also increases. So they have to update their policies to keep up with the changing investment options. For example, 30 years ago, 20 years ago, even 25 years ago, a bank didn't have a mortgage-backed securities to invest in. That wasn't a possibility. Well, today it is. So they have to have their investment policy that fits that need. Okay, so 3 reasons why banks cannot allocate all of their deposits to loans. As I said earlier, loans typically carry a higher interest rate than investments. So you would think, well, if a bank could loan out all of their money, why don't they? Well, these are 3 reasons why. Number 1, some loans are illiquid, which means they're difficult to either sell or securitize. We talked about the difference between loan sales versus loan securitization last week in class. Number 2, loans are among the riskiest assets of a bank. I mean, that's pretty straightforward. Again, when we get into chapter 16 and chapter 18, we'll talk more about loans, different types of loans. But if you're comparing, for example, a commercial business loan, risk-wise, to a government bond, there's no comparison. I mean, there's a lot more risk with the business loan. So as a bank, as an institution, you have to simply determine how much default risk do we want to take in terms of our loan portfolio and our investment portfolio. And then number 3, local economic activity can have an adverse effect on a bank's loan portfolio. And we've discussed this a couple of times in here, where if you're operating in an area that has 1 or 2 large employers and one of those employers shuts down, then your bank could be in a lot of trouble because a lot of those customers who have borrowed money from you may not have a source of repayment. So again, these are 3 things, and actually you'll probably want to mark these notes because you will probably see a question related to this on the test. All right, we've got another wasp in here. We've already killed one today in class. I'm waiting to see who the first person is to get up and run away from the wasp whenever it gets close to you. Once a wasp shows up in class, I have no chance in terms of keeping your attention, okay? I mean, he's parked right now. Kind of nervous, aren't you, in the back? Yeah, a little bit nervous. I was in Finance 330 today. Guy sitting right in front of me. The wasp landed right on his head, smack dab on the middle of his head. And I thought the guy sitting next to him was going to kill him with his notebook, was going to actually hit him, kill the wasp. It didn't happen, but all right, I'll let you know if it gets close to you. Just pay attention to me if it gets close to you. You got a hat on, you're safe, okay? I'll let you know. All right. Okay, so investments available to banks. The investments available can fall into two categories, and you probably, you study this in Finance 330. One are short-term investments, the other's long-term investments. So we call one money market instruments, the other capital market instruments. It just says here that Chapter 10 lists many of these investments, including the advantages and disadvantages of each. So I'll let you, part of this I want you to read on your own. We will go into and discuss some of the different items that fall within these categories. So the first category, money market or short-term instruments. So again, it depends on the bank, the liquidity that it wants, the return that it wants on its investments, because of course we know that short-term instruments, these money market instruments, are going to have a lower interest rate yield than capital market instruments, or they should. Now, number two here, this primarily consists of bonds. Now when we talk about capital market, officially, that includes stocks and bonds. But of course, banks can invest in stocks, so it basically leaves us with investing in bonds. So as we take a look at the money market instruments that could be used by a bank. Again, all banks don't use all of these, but this is a pretty comprehensive list. One of the most popular investments are simply Treasury bills. Treasury bills are simple. They're short-term, they're about as safe as you can get when it comes to an investment, and banks love Treasury bills. Also, short-term Treasury notes and bonds. So these could be, for example, maybe you've got a bond that's going to mature in a year. So that would fall into this category. Federal agency securities. We talked about this in Chapter 9. So Ginnie Mae, Freddie Mac, any of those government securities. CDs. Banks, just like their customers, invest in CDs. So they may put their money in a CD in another bank. That's not uncommon at all. Euro currency deposits, this is you don't really see that a lot around here. Mostly bigger banks deal with this. Bankers' acceptances, commercial paper, and then short-term municipal obligations. So these are short-term municipal bonds or bonds that are maturing within a year. So all of these are possible money market instruments that a bank could invest in. Now, capital market instruments. I said these are typically bonds that mature in 1 or more years. So, for example, Treasury notes and Treasury bonds, municipal notes and bonds, to a certain aspect, corporate notes and bonds, although again, the risk level comes into play here, so a bank has to be very careful in terms of how much risk it's taking with corporate notes and bonds. And then what we talked about last week, which are asset-backed securities. Typically, the assets backing this would be mortgages, although it doesn't have to be. You can take a pool of car loans, and you can use those car loans as the asset that backs a bond issue. Or you can take a pool of motorcycle loans or a pool of credit card loans or whatever and use it as the asset that backs a bond. You can get as original as you want in terms of creating these. The key is they have to remain investment grade. That's kind of the key to all of this. And then some of the kind of the newer investments for banks. You can have what's called structured notes, securitized assets, and we talked last week, I think it was last week, or maybe, no, actually this is on the recording that I made, about strip securities. So these can be interest-only strips or principal-only strips. All right, so the bank takes your deposit. It's got all of these investments that it can choose from. And as of 2016, so I went through and I updated this. So what are banks actually investing in? These are the 3 largest denominations. Obligations of the United States government and government agencies, state and local government obligations. Now, let me ask you this. These are municipal bonds. why would a bank want to, and we've discussed this actually before in here, why would a bank want to invest heavily in bonds issued by the local school system or by the local water department or some type of local agency? It does two things for the bank. What does it do? What? Okay, so did you say tax? Okay, so it's a tax benefit, okay? So you're not paying tax on the interest income. What's the second benefit to the bank? That's right, publicity. I mean, that's it. It looks good for the bank if they can say, look, our local school system they had a $75 million bond issue and we bought half of those bonds. That's free advertising for the bank. It looks really good, and it's also a good investment typic for the bank. So these are really popular. And non-mortgage related asset-backed securities. So like I said, this could be any other asset class besides a mortgage that through financial engineering is created and the bank could invest in that. So those are the three largest categories, the top categories. Okay, now we talked about investment policies. We'll talk about loan policies in chapter 16. But when it comes to investment policies, as I said, it really depends on the management of the bank in terms of how much risk they want to take. But as you can see, we've got some different factors here that affect the choice of what a bank invests in. And this is going to vary widely among banks. For example, the first one listed here, the rate of return. I mean, that's kind of straightforward and simple. Part of what you're trying to accomplish is you are trying to increase or maximize your net interest margin. And we'll look at a calculation of that when we look at the practice questions later tonight. So the higher rate of return that you can earn on your investment, the better off you are. But again, you have to weigh that against the risk involved with that particular investment. Tax exposure. Again, it really depends on the tax bracket that the bank is in. Some banks are in higher tax brackets than others. Also, maybe you had a bad year last year, and so in terms of taxation, you may be in a low tax bracket, but then this coming year, you're expecting to be in a much higher tax bracket, so you may want to alter your investment strategy to take advantage of that so that you can switch to maybe municipal securities, heavily into municipal securities this year to lower your tax burden. I mean, again, it really just depends on what's happening with the bank. Interest rate risk. Interest rate risk is the risk that interest rates will increase, which will hurt either the value of the bank or the equity of the bank. Credit risk, that's the risk that the investment will not pay off. Business risk, and we're going to talk about these in just a minute. Liquidity risk, call risk, some bonds are callable, some aren't. Prepayment risk, this goes back to the strips that we talked about, and if it's a principal-only strip, you may have that prepaid fast. If it's an interest-only strip, then if it prepays fast enough, you may actually lose money because you don't receive the interest from that investment. Inflation risk, and then pledging requirements. We'll talk about pledging requirements in just a second. So all of these have to be considered. A lot of people think, they kind of look at, a bank's investment portfolio, and they think it's fairly simple. They think, okay, a bank, all they do is buy government bonds. How complicated can that be? Well, actually, again, 30 years ago, it didn't take a lot to be the investment manager of a bank. Today, it's a pretty complicated process. So you have to be really on top of all of this in terms of what is your bank trying to accomplish, how much risk are we going to take. There's a lot of fairly complicated modeling procedures that you can use to help determine the most efficient portfolio possible for your particular bank. All of that goes into this. Okay, so it's a lot more technical than you might actually think just from the outside looking in. All right, now, tax exposure. What we're doing is we're going to take a look at each one of these. So, tax exposure. We talked about the tax status of state and local government bonds. Typically, these are free from taxation, which is a great thing if you're an investor. You've also got bank qualified bonds, which would be the investment grade securities. Some of the more sophisticated banks may get into tax swapping. That's something that most small banks, most community banks don't participate in. And also portfolio shifting. These last two are typically the larger regional and national banks are dealing with these. But that's what we mean by when we're talking about tax exposure. Now, when it comes to taxation, and if you've taken Finance 333, you've probably talked about this, and that is how to convert between a taxable yield and a non-taxable yield, okay, or a tax equivalent yield. So what I want you to do, I'll give you just a second to take both of these down. Because what we can do with these formulas is we can use these to compare a taxable bond to maybe a municipal bond, which is not taxed. Okay, so let's say, for example, let's take a look at the first formula here first, the after-tax yield. And let's say you're trying to compare the after-tax yield of a corporate bond compared to a municipal bond. So, the first formula here, we've got the after-tax yield is equal to, now let's say that this is the before-tax yield. So this is some type of corporate investment-grade bond that you can invest in, or possibly even a federal government bond, okay, because you still have to pay tax on the interest from the federal government bonds. And so I'm just using some nice round numbers here, okay? If you can find a government bond paying 10%, please let me know, okay? There aren't any out there. I'm just using this for example purposes. So, the taxable bond pays a 10% yield. The bank is in the 30% marginal tax rate bracket. So if we take the before tax yield multiplied by 1 minus the tax rate, that's going to be 10% times 0.7, which means that the municipal security, or the yield on the security that you don't pay tax on, would have to be 7% to be equivalent to the taxable security. And really, you don't care which of those you invest in, because the 10% taxable security is going to provide you the same yield after tax as the non-taxable security. The second formula, the tax equivalent yield, you would take the after-tax return divided by 1 minus the marginal tax rate. So again, it's going to do the same thing, except instead of taking it from the point of view of the taxable security, it's going to look at it from the point of view of the non-taxable security. And again, on your formula sheet for this test, you may just want to put those two formulas on your sheet. It's going to be like the last test. You're going to make out your own formula sheet, one piece of paper, and if you're given some information, you just plug them in, do the calculations. Pretty straightforward. It would be, yeah, I mean, it would read something like, for example, for this information, you may say something like, it may say, a bank is trying to compare the after-tax yield for, that would be equivalent to a 10% taxable bond if the bank is in the 30% marginal tax bracket. And so you're thinking, okay, they want to know what's going to be the equivalent non-taxable yield or after-tax yield, and so you'd plug that in. The other one, it will say either after-tax or tax equivalent, so you'll pretty much know which one to use. Okay, good question. Other questions about these two formulas? Have you seen these before? You probably saw these in investments, I'm sure, Finance 333. Mm-hmm. That's the same thing. That's the exact same thing. Now, like I said, with this may be a United States government bond instead of a corporate bond because banks tend to invest more heavily in those. But that it's the same thing. So it's comparing a municipal bond, non-taxable, to a federal government bond, which is taxable. That's exactly right. Okay, so everybody good with this? Pretty comfortable? How's our WASP situation? I haven't looked up to see it. Has he disappeared? Okay, what you don't know is he's probably crawling around on your table in front of you somewhere. You just don't see him. You kind of know who's really scared of WASP when you say something like that and you start to see them kind of shifting in their seats a little bit and kind of looking around. Okay. Everybody's okay so far? All right. Okay, interest rate risk. Again, these are things that you've talked about in other classes. We're just kind of putting them together here. You learn in your basic finance class, the first bullet point here, rising interest rates lower the value of previously issued bonds. So that's the negative relationship between interest rates and bond prices. Interest rates go up, bond prices go down. Interest rates go down, bond prices go up. Right now, and over the next few years, what do we expect to happen to interest rates? They're going to go up or down? They're going to have to go up, okay? And so if you know interest rates are going to go up, what do you think is going to happen to bond prices over the next few years? They're going to go down. So if a bank has a huge bond portfolio, and let's say that bond portfolio has a fairly long average maturity date, as interest rates go up over the next few years, those bond prices are going to go down. Now, it's going to depend on whether these are what's called held to maturity bonds, whether they're trading account bonds, as to how the bank actually has to handle this and the effect that it's going to have on the bank's balance sheet and income statement. Now, also you learn that when it comes to interest rate risk, the longest term bonds suffer the greatest losses. So if you've got a 25-year bond, 25 years to maturity, and interest rates change, it's going to have a larger effect percentage-wise on the price than would, say, a 5-year bond. And banks realize this. Banks also realize that they can use tools like futures contracts, options contracts, and interest rate swaps to help offset some of the risk or to even immunize the bank against interest rate risk. So we talked about that when we talked about asset liability management. We looked at some tools that the bank could use to help try to immunize itself from increasing interest rates. Okay, so interest rate risk, fairly straightforward. Default risk, this is simply the risk that the bond or the investment will not either make all of its interest payments or its par value payment. Now, when it comes to grading bonds, this is kind of a touchy subject among a lot of bankers, because the way it works is you have an independent third party or a supposedly independent third party like Moody's, Standard & Poor's. They come in and every bond issue is graded. Whether the city of Murray is issuing bonds, the state of Kentucky is issuing bonds, the United States government's issuing bonds, they're great. But just like you take a test and you get an A or B or C or whatever, bonds are graded. And the strongest bond issuers are rated AAA. So you can see here, and really the only difference is the notation. You can see that Standard & Poor's, they use all capital A's. Moody's, to be a little bit different, they use a capital A and two lowercase a's, but these are the strongest bonds you can invest in. Now, being the strongest bonds or the lowest risk, they're going to provide the lowest interest rates. So as an investment, these may be really safe, but they're going to have a really, really low interest rate. Now, as we move down to AAA, these are going to be rated a little bit riskier. They're still really strong bonds, but they're going to have a little bit higher interest rate associated with them because they do pose more risk. Then we move down to single A and then to triple B. These first four categories, these are what's called investment grade bonds. Okay? So first four categories, AAA, AA, single A, and triple B. Once we get below investment grade, so once we get down to double B, single B, triple C, double C, single C, etc., these are what's called speculative grade, or another name for these bonds, probably a more common name, what's called junk bonds. Now, I'm not going to jump off into junk bonds a lot because this is banks by law can't invest in junk bonds. But as investments, the name, when we talk about junk bonds, the name implies just something nobody would want to invest in. Who would want to invest in a junk bond? Okay? But actually, the name is speculative grade. That's probably a little more accurate because what this means is if a bond is, for example, a double B, it doesn't necessarily mean it's a bad investment. It just means it's a higher risk than investment grade. And for some investors, now not banks, but some investors, possibly you, this might be a perfectly good investment for you because it's going to have a higher return. It's going to have a little more risk. And so what happens is typically there's a cutoff point somewhere, and historically, although it doesn't mean it is right now, but historically it's typically right here between a single B and a triple C bond. Normally the default risk between a single B and a triple C, there's a huge difference between these two categories. So this is kind of the unofficial cutoff point where the risk really increases. As a matter of fact, if you look at triple C bonds and look at studies that have been done on triple C rated bonds, what you go from is about over a 5-year period, single B rated bonds, historically, you have about a 5% default rate, which means only 5% of the bonds issued actually default in 5 years. When you jump down to triple C, you've got about anywhere between a 30 and a 36% default rate, which means basically 1 out of 3 bonds are going to default over the first 5 years. Now, that's a lot of risk. Is there a yield out there that would compensate investors for that? Sure, there is. The problem is if you invest in this triple C rated bond and it defaults, I mean, after 5 years, it's a 30-year bond, you've got a ton of interest payments you're not receiving and also the par value that you're not getting back. So that's a lot of risk. But that's what we call default risk. The next category, business risk. You've got the definition listed here, the first bullet point. Business risk is the risk that the economy of the market area that the bank serves may decline. I gave you the example of early in the semester of Union City, Tennessee, and the Goodyear factory that was there. closing, or maybe if you're from the Mayfield area when the General Tire factory closed, that was a huge blow to the local economy. Also, the banks operating in that area, I mean, that was not a good thing for the local banks because they had millions of dollars loaned to employees of those two factories. They were very large employers. And so your security portfolio, your bonds, can help to offset some of this risk. Bonds issued by the United States government aren't really concerned or connected or correlated with the Goodyear plant in Union City, Tennessee, closing. Okay? Now, if you've got most of your bank's deposits loaned out across this local area, and your local area is suddenly hit by a downturn in the economy, it could close your bank. I mean, it's as simple as that. It could shut it down. So again, your investment portfolio can offset this business risk. And if you want to purchase municipal securities, but you want to diversify, you can buy even municipal securities from outside of your market area. So again, this kind of goes back to if in your local market area you have a sudden economic downfall and you've bought a lot of municipal securities from that local area, it's about the same as having loans made to that local area because there's a huge risk. But if you branch out to different areas, different states, for example, then you're going to decrease your business risk. Liquidity risk. We said liquidity for an asset or a liquid asset is an asset that can be converted into cash quickly without a significant loss of value. And so when we're talking about liquidity risk, we're looking at the breadth and depth of the secondary market on which you can buy and sell a certain investment. Typically for most banks, this is not a big problem. For example, if you've got Ginnie Mae securities and you need to sell them quick, you can do that. Okay, that's not going to be an issue and you're not going to lose money on them. If you have United States Treasury securities, Treasury bonds are one of the most popular investments around the world. Other countries love buying United States Treasury bonds. Why would that be? Why would other countries care anything about buying U.S. Treasury bonds? Default risk is one. Okay, a low level of default risk. That's exactly right. What else? Okay, I can't mark it, okay, but I can circle it with my little pointer here. Liquidity. If other countries need to raise cash quickly, U.S. Treasury bonds are one of the best investments for that because there is always a huge market for these bonds. 24 hours a day, 7 days a week, almost 365 days a year. Okay? And so these Treasury securities, very liquid, very popular, great investments. The problem is, for the last few years, interest rates have been so low that some of these investments have almost provided, well, at times they actually have provided a negative interest rate. Now, think about that. You invest money in something that provides you, maybe temporarily, with a negative interest rate. That's not very motivating when it comes to taking your money and instead of loaning it out and earning 7, 8, 9, 10, 11, 12% on it, you get to earn, if not negative, 1/10 of 1%, 2/10 of 1%, 5/10 of 1%. I mean, it's just not very attractive. Fortunately, we're seeing interest rates rebound slightly. Now, the offset of that is what we talked about last week and the week before, which was if interest rates go up from an individual standpoint, that means things like mortgage rates are going to go up. Student loan rates are going to increase. Car loan rates are going to increase. And so from from a consumer's perspective, that's going to hurt you, but for those lending money, that's actually a help. Okay, call risk. As you probably talked about in Finance 330 or investments, if you're taking investments, some bonds are callable. Now, this kind of goes through sort of how it works. This is the first part of it. It says corporations and some governments reserve the right to retire securities in advance of their maturity. All right, what does that mean? Let's say, for example, that, and I'm just going to use a corporate bond simply because it's a little bit easier than a government bond. But let's say, for example, I'm a corporation. I have issued $200 million worth of bonds. And again, I'm just going to use a nice round interest rate. Let's say at a 10% coupon. What that means is I pay interest on $200 million worth of bonds every year. So 10% of 200 million, please no one reach for your calculator. 10% of 200 million is how much? Oh, you're all panicking now. You can't reach for your calculator. Nobody wants a chance getting it wrong. 10% of 200 million is should I sit down? Should I try to find the wasp while I'm waiting for the answer? $20 million, okay? So they have to pay out $20 million per year in interest. That's a lot of interest. So let's say, for example, that interest rates fall. And again, I'm going to make this nice and simple. Let's say interest rates go from 10% and they drop to, for similar risk bonds, they drop to 5%. Well, just like as we talked about with mortgages, when interest rates go down, people tend to refinance their mortgage. They want to refinance it at a lower interest rate because it saves them money. Well, for this particular bond issue, if I have to pay 10% interest, I'm paying $20 million per year in interest. But if I have $200 million worth of bonds at 5% interest, I'm only paying $10 million per year in interest. So I'm saving myself $10 million. Now, I don't know about you, but to most corporations or to most bond issuing agencies, a savings of $10 million per year is significant. So, if a bond is callable, what that means is if interest rates go down during the life of the bond, then it says they can generally be called when interest rates have fallen. I can simply contact, let's say all of you are the people who own the $200 million worth of bonds, you're the investors. I contact you and simply say, guess what? Remember that little callable clause that was in the bond contract that I sold you? Well, guess what? I'm calling the bonds, which means you have to sell me back those bonds. Now, as investors, you're not happy about this because right now the market rate of interest for taking the risk that you're taking is 5%, and your bond that you own is paying 10%. You don't want to sell this bond. The problem is you don't have a choice. Now, I'm a fair person, okay? So what I'm going to do is I'm going to give you, instead of the par value of this bond, I'm going to give you what's called the call value or the callable price. Now, that's going to be, let's say they're $1,000 bonds. So instead of $1,000, I may give you a whopping $1,050 for each bond. And you're thinking, that's no help whatsoever, and you're probably right. Okay, but that's just how it works. So I'm going to call these bonds. I'm going to then refinance and issue my $200 million worth of bonds at the current market rate of interest. I'm now saving $10 million per year, and if you want to invest in one of my bonds, again, that's fine, but you're going to earn only 5%. So that's what it means here when it says investors must find a new investment or new security, often with a lower rate of return. You don't have a choice. Okay? Now, because of this, if a bond has a call feature, oftentimes it's going to provide either a little bit higher yield to compensate investors for the risk, or it may sell at a little bit lower price to compensate investors for that. But as an investor, if you're buying a bond, you should know if it has a call feature or not. I mean, that's a huge part of any bond issue. So that's what we mean by call risk. Simply means the bond may be called. Okay, prepayment risk. It says this is specific to asset-backed securities. Now, we discussed this again back in chapter 9 a little bit, and in the handout it discusses this a little bit. Second bullet point here, most consumer mortgages and loans can be paid off early. Now, the way it works is, if you have let's say that you've got a $100,000 mortgage. So you bought a house. We're not concerned with what the house costs. It doesn't really matter. You've just borrowed $100,000 and used the house as collateral. So that's a mortgage loan. And you decided you wanted to take Finance 330. And in your Finance 330 class, you talked about how if you paid additional on the principal, that you can have your mortgage paid off faster than the original borrowing period. So let's say this was originally a 30-year mortgage. You paid extra on the principal. Maybe you had some money from different places. You just threw money at that mortgage loan. And instead of it being a 30-year mortgage, you paid it off in 12 years. First of all, that's pretty impressive. Now, what this means is, when we're talking about prepayment risk, is we talked about, when you listen to the recording of chapter 7 in your textbook, it's going to talk about something called interest-only strips and principal-only strips, or IO strips and PO strips. When it comes to mortgages, through financial engineering, and we've talked about this some, you can create all kinds of investments, all kinds of bonds. You can create some bonds whose the cash flow that makes the interest payments and the par value payment is related just to the interest portion of a pool of mortgage loans. So whenever you write your check out every month, and we know that if it's an amortizing loan, part of your payment goes to principal, part of your payment goes to interest, that when you make that interest payment, it is going to fund the cash flows to the interest-only strips. And as long as you keep making your interest payments, everything's fine. But what happens if that's a 30-year bond created from a pool of 30-year mortgages? We're assuming borrowers are going to pay interest payments for 30 years, but let's say that most of them pay off their mortgage early. What happens to the interest payments that are related to these 30-year mortgages? Once you pay off your mortgage in 12 years, how much interest are you still paying? None. Okay? Your mortgage is paid off. You don't pay any more interest. And so the cash flows going to these interest-only strips disappear, which means that they're in default because they now no longer can make the interest payments, much less the par value payment when the interest-only strips mature. Now, principal-only strips are a little bit different. When it comes to a mortgage, if you pay this mortgage off, this $100,000 mortgage off in 12 years, or even if you refinance the mortgage, the principal is always paid off. That's the amount that you borrow. So principal-only strip holders, they don't necessarily worry too much about prepayments. If you're an interest-only strip investor, you're really worried about prepayments. And if interest rates start dropping, you really start getting worried because that's when most people are going to go in, refinance their mortgages, which means you're not going to get the cash flows to pay off your investment. You might not even actually recover your initial investment in the interest-only strip, much less a profit related to it. Okay, so that's what it means by prepayment risk. You have inflation risk. Somebody tell me, what is a simple definition of inflation? What? Okay, when prices go up, that's exactly right. So inflation is when prices go up or when the purchasing power of a dollar goes down. It means the same thing. So if we're talking about inflation risk, it says that the purchasing power from a security or an investment can be eroded by rising prices. And you've got some bonds that have been produced that are supposed to protect investors, for example, a Treasury inflation protected security. But again, this is a possibility. Now, this of the risk that you face, this is probably one of the lesser ones that you would worry about as a bank in your investment portfolio, but still it's a risk that you need to consider. And the last thing that we had discussed on that list was what's called pledging requirements. And this is something that a lot of people really may not think about, but it's pretty important to banks because it can be a major pain in their side if they have too many government deposits. All right, so the way this works is, it says depository institutions, so I'm going to substitute banks in there. So banks cannot accept federal, state, or local government deposits unless acceptable collateral is pledged. Now, unless you work at a bank, and even if you do work at a bank, you may not realize this, but there are times during the year when your bank has a lot, millions and millions of dollars of federal, state, or local government money. It could be anything from school money, when you pay property taxes in the fall of each year, that money has to go somewhere. So depending on where's the sheriff or whoever's collecting that property tax money, they have to put it in a bank. So let's say, for example, that they have a huge property tax inflow in November of each year. You've got $1 billion worth of property tax money flowing in. They're going to park it somewhere temporarily. So typically that means they're going to park it in a local bank. They may split it up among 2 or 3 banks. Now, when you put taxpayer money in a bank, you have in effect FDIC insurance up to the maximum amount, which is going to be $250,000. But if I'm putting in $1 billion worth of taxpayer money and I'm insured up to $250,000, there's a little shortfall there. Okay? Approximately $750,000 shortfall. So the bank legally has to pledge securities that if something goes wrong and that bank collapses, or the CEO of the bank embezzles millions of dollars and runs off, the bank has to pledge U.S. government securities or bonds against the tax money. Now, that may not sound, that's what this is talking about, is collateral. That may not sound like a big problem. But again, we talked about bonds being a form of security. Bonds are also a form of liquidity. So what if a bank has to raise money quickly by selling government bonds, but you have those bonds pledged against tax money that's in your bank temporarily that you didn't really want there in the first place? What do you do? I mean, can you sell those bonds if they're pledged as collateral? Protecting United States taxpayer money? I'll go ahead and answer that question for you. No, you can't. So even though you have purchased liquid securities that you can sell quickly, because U.S. taxpayer money was placed in your bank and you had to use those bonds as collateral, those bonds are now no longer liquid. You can't sell them. And you're hoping that whoever put the money in your bank, the tax money, is going to take it out as soon as possible. Because then those bonds don't have to be used as collateral any longer, and they could be sold to raise cash quickly. So this is what happens whenever your tax money from whatever, school systems, property taxes, whatever it might be, is put in a bank. Okay, so this is a legal requirement. It's called a pledging requirement. Okay, now we talked about this a little bit earlier. I'm going to let you take a look at this, but I'm going to focus on one of these. Or I want you to focus on one of them. Well, actually, your practice questions talk about one of these. There's different investment strategies that you can use. So if you're a bank and you're buying bonds, you can use, for example, what's called the ladder policy. You may know what that is. You might have talked about that in investments. Okay, the ladder policy, I mean, it's pretty simple. It's basically where if you're buying bonds, you're going to buy bonds that mature in increments of maybe 1 year, 3 years, 6 years, 9 years, 12 years, 15 years, 18 years. It's going to be a nice ladder of maturity. And that's the strategy that you use. The reason that you use that strategy is because interest rates change, and as those bonds were being issued, some are going to have higher interest rates than others. Some banks are perfectly happy with that strategy. You might have what's called a front-end load strategy. You might have a back-end load maturity policy. You may have a barbell strategy where you have a lot of bonds that have very short-term maturities and a lot of bonds that have very long-term maturities and not much in between. You've got what's called a rate expectations approach, which you kind of get into trying to guess what's going to happen with interest rates. So again, what I want you to do, it's kind of hard to see here in the red, but read about these in chapter 10. Focus on this strategy. I don't think I can make it any clearer. Focus on the red strategy. Okay? And the kind of the last part of this chapter, it goes into it and we're not going to spend a ton of time here, but it talks about available for sale versus held to maturity. And the first question here is, what does all this mean when we talk about held to maturity versus available for sale? The name's pretty straightforward, okay? A bond that is held to maturity, as the name implies, is when a bank buys a bond and it has no plans on selling it. If it's a 30-year bond, it's going to buy it, hold it for 30 years. Hold it until it matures. Available for sale, as the name implies, means this is a bond that the bank can sell if it needs to or wants to in the future. The important difference here is you've got three different classes: held to maturity, trading, and available for sale. The important difference here is how these are treated in terms of accounting. And so that's what we're going to, when we take a look at these next couple of slides, we'll be able to see exactly what the difference is in treatment. So these accounting standards require a bank to classify these investments when they purchase them. Okay, so that's the difficult part, because as soon as you buy a bond, you have to place it. Is it a held to maturity? Is it a trading account security? Is it an available for sale bond? And It says here the classification is based on the bank's intended use of the security, and the classification dictates the accounting treatment. So the first one listed here, available for sale versus held to maturity. Okay, held to maturity, these are debt securities or bonds that the bank has the positive intent and ability to hold until maturity. They're classified as held to maturity and are reported at amortized cost. Okay, so here is the question related to this. What does that mean if we're talking about the amortized cost of a bond? And I've got a class full of senior, for the most part, second semester junior, finance students, and maybe the occasional accounting student. Okay, say that again.
It's how the price changes and how the value of the bond will go down.
Okay, so let me start out with something simple. Depreciation. What is depreciation? Okay, so depreciation is the allocation of the historical cost of an asset over time, a tangible asset. Okay? Amortization is the same definition. The only difference is it's related to an intangible or non-intangible asset, okay, or financial asset like a bond. So basically, amortized cost is when the price simply, if you buy it at a premium, then you're going to have it fluctuating towards par as the bond heads towards maturity. If you buy it at a discount, you're going to have the price of the bond increasing towards maturity or towards par as the bond matures. So the important part here is underlined. It says the impact of temporary fluctuations in fair market value of bond is not reflected in the bank's financial statements. Now, this is the important thing. What this means is, in simple terms, if you buy a bond, you place it in the held to maturity category, you don't have to worry about accounting for amortization or price fluctuations each month on your balance sheet and or your income statement. You just own the bond. That's it. Okay? So it's a really simple process compared to the next one, which is a trading account security. Okay, so this says a trading account security is, I'm just going to say bond, a bond that is bought and sold principally for the purpose of selling them in the near term, and they're reported in the financial statements at their fair value. And the important part here is underlined, changes in the fair value of trading securities from period to period are reported as a component of net income. Now, this can be a big hit to your income statement, and you haven't done anything different. So, for example, we know that if interest rates go up, what happens to the value of bonds? They go down. Okay, this is why we spend so much time on this in Finance 330, is because it actually is a real world application. If you've got a bond and you have it classified as a trading security, if interest rates go up and you lose, let's say, $2 million worth of value of your trading account bonds, that doesn't just affect your balance sheet. You have to write off $2 million of loss to your net income on your income statement. Now, sitting here in class on a Tuesday night, that doesn't sound very important. But if you're the CEO of this bank and you're having to report your income quarterly on your call report, and your stockholders are seeing your income, that's a huge loss. Because you're trying to explain to the average person who hasn't had a banking class that, look, this is just a bookkeeping entry. This is a trading account security. We bought this bond or these bonds to buy and sell, and they're going to fluctuate in value. The average person doesn't care about that. All they care about is somehow you're running this bank and you lost $2 million, and we don't understand how you did it. Truth is, you didn't do anything different. You just had to write down the value of your securities because you had classified it as a trading account security. Now, this is not an accident that this is such a severe, I'm going to call it a penalty, because you actually could have an increase in value too. Okay, so that's going to make your income look better. But it's not an accident that this is such a severe penalty, and that's because regulators don't want banks classifying many of their investments as trading account securities. Because what they say is banks aren't in the brokerage business. They're not in the business of buying and selling bonds, or they shouldn't be in the business of buying and selling bonds. That's why this is such a severe penalty if they try to classify very many of their investments as trading securities. And then you have what's called available for sale. So this is, again, I'm going to say just bonds. Bonds not classified either as held to maturity or trading are considered available for sale and are reported at fair market value. And the important part, again, is underlined here. Changes in the fair value from period to period are not reported as a component of net income, but are charged or credited directly to equity. So what this is saying is when you have an increase or decrease in rates, the increase or decrease in the value of the securities, it doesn't go to income, it doesn't affect your income, but it does affect your equity or your capital position in the bank, which that's going to be actually chapter 15 when we talk about capital. So what I want you to know for test purposes is for each of these, know the definition of this, but also know how we have to treat these in terms of accounting, depending on if something is labeled held to maturity, trading, or available for sale. And that's going to be the underlying portion of each one of these slides. All right, and finally, that is a somewhat painful, according to your faces, chapter 10. So let me ask this before we take a look at your study guide for the test. Are there any questions about chapter 10, the investment function of a bank? No questions. Okay. Then let's okay, now what you're gonna notice when we take a look at the study guide is there's a lot of material on this test. Okay, it's 3 chapters from your textbook and then the handout chapter. So there's a lot of stuff here. We started with chapter 7. That was the asset liability management chapter. So that was a chapter where when I finished and I was looking at you, you kind of had this, well, kind of like you had the light on your face, although it was a little bit worse. It was kind of this blank stare of what the hell did he just talk about? That's where we went through, remember the gap analysis and if a bank was asset sensitive or liability sensitive and that type of thing. So that's what we're talking about here. the definition of asset liability management, what's its purpose, what were the historical views of asset liability management, which they're listed here. They're also on the slides. The main goal of interest rate hedging. What is net interest margin? How do you calculate it? You can also have the formula for that on your formula sheet. Know how to calculate and interpret the various interest-sensitive gap measurements, such as the dollar interest-sensitive gap, the relative interest-sensitive gap, and the interest-sensitive ratio. Be able to identify an asset-sensitive bank and a liability-sensitive bank and know what position is preferred if interest rates are forecast to increase or decrease. Be able to calculate a cumulative gap, so that's just a total gap moving forward, and how a change in interest rates will affect the bank's net interest income and net interest margin. And then aggressive versus defensive gap management. We said in aggressive gap management, that's when you try to take advantage of interest rates increasing or decreasing by situating your balance sheet in a way that you're going to make more money if rates go up or down. A defensive gap management strategy is when you try to be perfectly hedged. So if interest rates go up, it doesn't affect you. If interest rates go down, it doesn't affect your bank and the profitability. And then finally, basis risk and weighted gap. You know, what is it? How do you calculate it, et cetera? And that was referring to the fact that interest rates on assets tend to increase faster when rates are going up than deposits. And if rates are going down, interest rates on assets tend to decrease faster than deposits. Is that right? No. They decrease slower than deposits. Deposits, if rates are going down, deposits tend to decrease faster. All right, so this is kind of a combination of the mortgage markets handout that says Chapter 7 on it, and then Chapter 9 from your textbook. So don't get this Chapter 7 and this Chapter 7, okay, the handout. Don't get those two confused. So this is what I'm referring to there, okay? All right, so you need to know what's the definition of a mortgage. What's the definition? What is securitization? Let me move this up. The difference between securitization and simply selling a mortgage. What's the difference there? What are the benefits of securitization? Also, mortgage characteristics. So we talked about definitions of each of these. What is collateral? What is a lien? What is a down payment? What is private mortgage insurance? The difference between an insured mortgage and a conventional mortgage. The maturities of a mortgage. What is a balloon mortgage? The difference between fixed rate versus variable rate or adjustable rate mortgages, and discount points. What's the definition of discount points? Also, be able to work the end of chapter questions. We talked, you've got listed there mortgage payment calculations, whether to pay points or not. Also an amortization schedule. What is it? How do you calculate it using your financial calculator? What is the primary mortgage market? What's the most popular types of mortgages measured in dollars from largest to smallest? So we talked about 4 different types. What's a secondary mortgage market? What does it mean if you're selling a mortgage with recourse or without recourse? Okay? And remember, if you sell one with recourse, if the loan goes bad, you can force whoever sold it to you to buy it back. If it's sold without recourse, that means you're basically stuck with it if you purchase that mortgage. And then the 3 major forms of mortgage securitization. So what is a pass-through security? What is a collateralized mortgage obligation? And within that, I talked about interest-only and principal-only strips. Now, this is what I had recorded on Tegrity, so you need to listen to that recording. And then mortgage-backed bonds. And then finally, what do these mean? If you talk about Ginnie Mae, Fannie Mae, or Freddie Mac, what does this mean? For example, this stands for the Government National Mortgage Association. This stands for the Federal National Mortgage Association. This stands for the Farmers Home Loan Mortgage Corporation. And then Chapter 10, which we covered tonight, the function of a bank's investment portfolio. the 3 reasons banks cannot allocate all deposits to loans. What are the investments available to banks? What are the risks associated with bank investments? We talked about default risk, business risk, liquidity risk, call risk, prepayment, and inflation risk. What are pledging requirements? Why do we have pledging requirements? What are the different maturity strategies? And I told you to focus on one of those. And then what does it mean in the difference between available for sale and held to maturity? And primarily, what's the definition and what's the accounting treatment? How are these securities handled at the end of each month or the end of each quarter? All right, so that is your study guide for test 2. Now, let me bring this up really quickly just to make sure there's no questions about this. Okay, now if we go to the practice question, I'm just going to go to the ones with solutions so you can see what's listed here. Make it a little bit larger. All right. Now, I'm not promising you that this is going to be very attractive. I kind of worked through these pretty quickly, but you can see there are several practice questions here that are really, really good study questions. Some of these are multiple choice, some are true, false. And so you can kind of go through these yourself if you want to. And it basically discusses everything that we just talked about, or a lot of that we just talked about on the study guide. So here's, well, for example, number 9. It says if a bank is being aggressive with its gap management, it would want to be liability sensitive if interest rates are rising. Well, if it's being aggressive, it means it wants to make money if interest rates go up or down. And so if interest rates are going up, you would want to be asset sensitive and not liability sensitive. Okay, so that would be false. Here's a simple definition. Asset liability management, the process of controlling a bank's sensitivity to changes in market interest rates and limiting its losses in its net income or equity is called, that's fairly straightforward, asset liability management. Campbell's ratings. S portion of the Campbell's rating represents which of the following? So it represents sensitivity to market rate changes. This goes back to chapter 7 from your textbook. If interest rates increase 1 percentage point for a bank that has a 1-year cumulative repricing gap of $3.5 million, the approximate change in net interest margin is how much? You simply take the the repricing gap times the change in rates, and that means it would be a $35,000 increase. And then you've got just several other multiple choice, true, false, and calculation type questions. So you've got 20, wow, actually, more than that. Okay, so 35 questions total. Okay. Towards the end here, this is loan calculation, this is amortization schedule. You've probably got one. Okay, so here's a points versus no points question. So really, these practice questions pretty much cover everything that we've talked about in class. So what I'm going to do is I'm going to leave this for you to take a look at these questions. Some of you may want to come talk to me about several questions here. Others may look through it and you may not have any questions whatsoever. Okay, so I'm not going to keep you here to go over this, but if you do want to sit down and talk about these or talk about how any of these were calculated, come by and see me, set up an appointment with me, whatever. I'll be happy to talk about it. All right, so next week is your test. I'm going to record chapter 15 on integrity. That'll be on test number 3. And then 2 weeks from tonight, we'll cover chapter 16 and 18. I think those are the two chapters. And then you'll have your third test. All right, so quite a bit. You got your paper too. Don't forget, it's due the, what, 30th? Is that right? Is that what I said? Yeah, okay. All right, so study hard. Spend some time on this, okay? This is a pretty big test, so spend some time on it. Everybody have a great week. I will see you back here next Tuesday night.